Yeah, 5, 4, 3, 2, 1. Ladies and gentlemen, we got 700 in Geneva in about a couple of seconds. I would be a ringing bell, which rings exactly the same sound as Big Ben in London, but it is smaller, it is much more modest, actually more or less the same as any other thing in Switzerland. Today we got an international, completely international discussion because I see participants who join us from very far east, and some of them are from India. I'm here in Geneva, and we got my co-speaker, Michael Dennis from United States. So we nearly covered the whole globe, at least by a quarter. Michael, today our topic is trade credit performance measurement, and today we are speaking about credit, mainly because this whole thing is called credit chats. And we know each other because of credit, but we also know that, credit is not the only thing in our life.
Mhm.
I always ask, and we try to present all of the co-speakers as much as it is as it is possible on social media and everywhere. But there is always a short version,
Mhm.
which maybe one sentence, maybe a couple of sentences.
Mhm.
You can use as much as you wish, but how you define yourself? What is your short version of yourself? How you feel yourself?
So I'm a gym rat.
Okay.
I'm a marathon runner.
Okay.
I'm a writer.
Wow.
Yeah, as you are.
I mean, this is for me. This is the hardest job in the world.
Yeah. I'm a consultant, and what I enjoy doing is, after many years, as you have in this industry, is sharing that information, whether it's in writing or in person or with consulting clients. I like transferring what I've learned and making it edible for my audience at whatever pace they're willing to accept the information.
Great. Thank you. Thank you. That's why actually I created the word creditologist, just to have to do it not in one sentence, but even in one word, just for the simplicity.
Mhm.
But again, today we are speaking about performance measurement, and I suggest we start with our first question, which was published, which was said to the audience. When we say performance in relations to credit, we know that credit management function is, let's say, multivalent. It is interconnected in the different. It has many different stakeholders within the business. So when we say credit performance, we say about what? What is the strange animal running in the forest, or this is something else? So how would you see that magic thing which we call performance? Before we start to measure, we need to understand the subject. So how would you define that subject?
So I think the subject is defined by the ways that we describe the goals for the credit department. We create measurements that evaluate our success at reaching the goal. Let me give you one very simple example. Let's say our goal is to maximize or optimize sales.
Yes.
Okay, great. That's a goal. Let me give you one more. Find ways to make sales more safely.
Yeah.
Okay. Now we have two goals. Maybe a third goal is collect money quickly. Okay, now we have three goals. Once we define what the goals are, and there's more than three, but once we define what the goals are, now we can create measurements. And we can create measurements around the things that management has told us should be our goals.
Yeah. So does that somehow mean that credit management is not a separate business?
Mm-hmm.
Yeah, credit management normally is part of the company. Since we clearly defined, we were speaking about trade credit. Yeah,
Mm-hmm. Mm-hmm.
and we believe that there are some universal goals, there are some companies, or let's say market specific goals. And obviously, I don't believe we had with one of the colleagues, we had that discussion, like could the company have separate credit strategy, which would be in contradiction with company strategy? I don't believe this could exist.
Well, no, I agree with you. For that to exist, the credit department would need to be apart from instead of a part of the organization, and
Absolutely.
it isn't. That would imply that we create our own goals, which we don't.
So there are some universal goals, and there are some company-specific goals. So that some of the goals might have different priorities.
Mm-hmm.
I personally define 4 of them. I try to make it universal, or at least closer to that.
Mm-hmm.
So first one, I simply think, what is the reason of accounts receivable, which we all work on, to exist?
Mm-hmm.
And we may speak, obviously, we do know that accounts receivable do not exist to provide job for credit managers.
Okay.
That's very far from being reasonable, yeah.
Mm-hmm.
So, like we got our job because there is accounts receivable. I can be even more drastic. Business does not need credit manager. Business needs companies or customers who order, pay on time, and order again. And then business needs somebody who is able to organize that. And if credit manager is the same person, is exactly that person who is able to organize that, this is good. So, first of all, receivable is supposed to play their role, is supposed to deliver the results they exist for, meaning sales support. Otherwise, that's what we started in our pre-party. Yeah, everybody can improve receivables at cost of sales. There is no need to even make an effort. Second thing, obviously, no one will take from credit department responsibility for 2 more goals: bad debts and overdue.
Mm-hmm.
Neither thing will make us free of that. So we could not say, even if, let's say, final decisions taken by management, there is still responsibility of credit to control, to collect, and do our best to deliver that. And it might be a surprise, it might be already seen as a challenge to deliver sales support and bad debts and overdue at the same time. But honestly speaking, this is not that difficult to deliver. Might be challenging, but this is not like, jump into the moon. The problem is, there is, we can all achieve that if the budget is unlimited.
No, and I'm glad that we disagree. And I told you we would. So
No, I just finish, and then we will, because I wanted to create that. I wanted to create that, so I did that for the purpose. So it is difficult, but it is still possible to make it if budget is unlimited. But the key idea is to support sales, reduce bad debts and overdue at the same time, and within the reasonable budget. And from business point of view, I'm just checking idea against you. And from business point of view, every of these 4 goals could be achieved separately. But the problem, good credit manager and good credit function or good credit department supposed to deliver all of them all together.
Together, yeah.
So that's what's the beauty of professional credit management, because it deliver real results business needs. What would you say?
So there's an old
You said you are disagree. I'm here to learn from you.
So there's an old joke in English that says, you can have it good, or you can have it fast, but you can't have it good and fast. Okay, so it's a joke. It's a phrase. So let's first acknowledge that bad debts are an inevitable result of extending credit to customers.
Yes.
Can't avoid them. If you're going to extend credit on open account terms, some people aren't going to pay you.
You open the door. You open the door to possible bad debts.
Sure.
Yeah.
And it doesn't matter whether you're selling to somebody working in a garage, or selling to a Fortune 100 company. You are at risk of bad debt losses every single time you extend credit. It's lower with the Fortune 100 than the garage, but it exists. And the same is true of payment delinquencies. Whether you're selling to a Fortune 100 or a guy working from his garage, you are at risk. Once you've extended credit, once you've shipped the goods or provided the services, they may pay you on time and they may not, for a variety of reasons. And there's nothing we can do to prevent bad debt losses. We can limit them, we can minimize them, we can manage them, we can do better at evaluating. Yes.
I just marked the point.
Yeah.
The word nothing.
Yeah.
I would disagree.
Okay.
A lot of things we can do, but we cannot guarantee results.
Right. And that's the point I make.
That's where I believe we are common.
We cannot eliminate the risk of serious payment delinquency,
absolutely,
payment default, without limiting credit.
Absolutely. Okay. I mean, no one can guarantee.
Sure,
Here,
sure. So one of your points was, if we had an unlimited budget, doesn't matter. If we have an unlimited budget, we still don't have insights as to what customers are going to do. We have the most readily available information. We have the most expensive information. But, well, let me put it this way. Probably half the time my customers have filed for bankruptcy, I've said to myself, wow, I did not expect that. The other half of the time, I'm going, yeah, they were on my risk list, but not on my do not ship list. And I think most of the people that are listening say, yeah, that's probably true. I don't know that I was that good that I could. And by the way, if to anybody listening, if you believe that your customer is actually going to file for bankruptcy protection, this is a rhetorical question. Are you still shipping to them? And if the answer is yes, why? Why? But the reality is, these things catch us by surprise, even if we have up-to-date credit files with relevant information in them. And that's why I say we can't prevent it. We can mitigate it, we can manage it, we can limit it, we can control it. And that's why, at least in the US and North America and the places that I consult in Western Europe, they have bad debt reserves. And they say, you need your losses to be in this range. And that range is never a zero. It's always a range of lost numbers. Okay.
Look, first, I wouldn't say what I said if I didn't see that myself, and if I didn't create myself. I believe, but at the same time, I do understand that I admit that significant part of that was really a good luck.
Mm-hmm.
So the thing is, so if we go philosophically on that, we're supposed to say that, okay, everything we got in our life is that, a hope that our best would be enough.
Uh-huh.
Sometimes our best, we all, the only thing we could do is to do our best. Yeah, make sure we did our best for that, and then we got result. We got what we got.
Mm-hmm.
Either it is bad debt, or results in running, or whatever it is. But well, that's why I said there is nothing we can do. I don't believe this. There is a lot we can do,
Right.
but this a lot or our best could not guarantee result for the company. But what we could guarantee to a company is that we would do our best, and we can say to our management that with this setup, we're supposed to have bad debts from this to that.
Hmm.
And that's one side of the story. So, for instance, if a company is going to gain another, I don't know, another piece of market pie,
Hmm.
and the company is supposed to grow its market share. It's supposed to be more aggressive in terms of credit.
Hmm.
This is our job to say to a company, this may bring another piece of bad debts, and this will be growing, and this will be this would be the cost of that. This will be the cost of that market share growth, and we're supposed to be able to say that. And just elimination of bad debts to give you an example, it's quite easy. We can cover everything by bank guarantees,
Hmm. Hmm. Sure.
and we will have zero bad debts. But the cost,
Hmm.
bad debts will be zero, and this won't be at cost of sales.
Hmm.
But the problem, and by the way, bank guarantees is very very nice instrument to improve customer payment discipline.
Sure.
Very well, it works very well. But the cost of that could be much more higher than possible bad debts. This is it. So, but coming back to where we started,
Hmm.
if we strive to that zero,
Hmm.
we will have tendency to that zero. I don't
Yep.
believe we will achieve it.
Right.
This will be much more. We will always have much more better results than if we simply, use this tranquilization. There is nothing we could do about that because management takes decision in favor of sales, and this is it. Please, Michael.
Sure. So lots of things to unpack there, and I appreciate that sort of runway to go with this. So one of the things that occurs to me, and you used an example of your company is acquiring another company,
Yes.
and or your company is seeking new market share, and they've opened up this new market. A very simple example was we did business only in the United States, and now we're going to do business in Mexico. And we, at that point, and by the way, this happens every day across America. Companies
Sure.
acquire each other, or around the world, of course. And the dilemma that we have is we don't know much about the risk of the new portfolio, whether it's a new country, the company we're acquiring. That's a big question mark. It's a big X. We have no idea what it's going to be like. One of the things that I think we as credit pros don't do well, and I'm speaking generically, maybe you do it great to the listeners, is we don't do enough. In English, I'll use the expression CYA, cover your assets. It means we don't do enough to ensure that our back is protected. We could say, oh, we're going to do business in Mexico, and that it represents higher risk.
Yes.
But then we don't measure. We don't do performance measurements on the additional risk. And then 6 months down the road, management knocks on the door and says, why are our delinquencies so far up? Or why are our bad debts what they are? And I think, as a general statement, we, the credit pros, need to have performance measurements that talk to the things that are important to us. And one of those things that's important to us is making sure management understands how significant the risk is.
Absolutely.
And you can create monthly metrics, and one comes immediately to mind. Just do an analysis. If you like DSO as an example, do DSO for your domestic sales and a separate DSO for your Mexico sales. And when they start diverging, where DSO for US is 30 days and DSO for Mexico is 90 days, when management says, how come the combined DSO is now 60 days? You say, well, it hasn't changed in America, but in Mexico it was 90, and when you combine them, that's why it's 60 for the company. But that's well understood by everyone on the phone. Everybody understands that we could do that. It's surprising to me as a consultant how few companies, how few credit pros do that. Break it down, describe in detail on a monthly basis regularly to management. And that's, yeah, back to you.
I completely agree with you. The thing is, I believe we, again, in general, as credit pros, we disregard too much things like planning and things like portfolio analysis and things like business review and communication. What are you talking about? I see as a credit pro who prepares a portfolio report and delivers a presentation every quarter or every month, depending on the group or subgroup, with sales, with, I don't know, higher management. And if, for instance, we are speaking about a company who goes from which used to sell only in the United States, and it enters the market of Mexico. I will tell you a joke about that later on. So this means that we're supposed to take very principally and very detailed the sales volume expected is X. Then accounts receivable based on payment term, what we could call BPDSO, is Y. And then with this Y of receivables, how much portfolio risk we take, so based on customers' credit worthiness. What are the payment terms? What is the normal behavior of this? And this everything is to be calculated, put on slide, and deliver it to management. So when management takes a decision to enter this market with this or that challenging target, they know not only cost of marketing, they know not only cost of people sitting there, which is delivered by marketing and HR. They know not only cost of sales who will go there and selling there. They're supposed to know the cost of credit, which supposed to be added all these costs, and then they know a comprehensive cost of that market expansion.
Sure.
Because otherwise, if we simply sit, we will give 90 days because customers so and management approves, and then how different we are from that accountant or from that sales manager who believes they are able to manage credit. We are not different from that. We are exactly the same. We do the same thing. That's, it was like, to me, there was very often we got this question, like, how can we raise the profile of credit management? Simply say, we cannot raise the profile of credit management by just controlling and collecting.
Right.
That's impossible. We already did that, and nobody see that as a valuable job, because every computer can send dunning letters, and every computer can send can control. That's what we discussed. We're supposed to do something more, something different. Okay, and the joke about Mexico. Mexico and World Credit Congress. Just to make a bit of refreshment. I think that was in Romania, and I was presenting about risks in Central and Eastern Europe with portfolio analysis, and I started unofficially I called my presentation "Scary Movie." So when I finished, there was Luis Mata, I believe you know him, who was wrapping up the World Credit Congress and said, "Andriy, thank you for the presentation. If you would like to be scared, come to Mexico." So if you believe what then I understood what he said. Later on, I've seen a couple of documentary movies about Juarez, which is called actually Hell on the Earth. So I understood what he's talking about.
Yep.
Okay, so we understand that performance. There is something tangible about performance. This should be appropriate numbers, and they are, we like it or not, jumping around more or less the same thing, because we need to support sales, we need to collect cash, we need to make sure our overdue and our bad debts are not growing otherwise, or at least they are growing in a planet in the planet in the corridor we planned for. So they're supposed to go. And finally, this supposed not to come with the enormous cost. One of the questions, we already mentioned risk, and in the methodology I try to promote, I believe that we still could measure the effectiveness of our job in credit management, or let's say in credit risk management, by bad debts, because we got tangible results. I will explain my position. I completely agree with you that we cannot eliminate bad debts without bank guarantees. So anyway, there will be cost to that. But if we take two companies, one has a bad debts which are growing like every year in annual report, and in other company there might be a bad debt which happen occasionally. Like credit team did their best, they did even more, but I mean, we cannot we cannot just simply jump to the moon. We need a rocket for that. If there is no rocket, we did our best. So I believe that bad debts could still be the measurement. But at the same time, we can look at portfolio risk. So what is the best measurement for that credit risk? Because in the picture I've shown, there is a bad debt as a measurement of our effectiveness in credit risk management. Although I don't believe in the existence of such a category, but what's your opinion on that?
So it's a really fun topic, and let me start.
Let's have it. Let's have this.
Yeah, let's have it.
That's why we're here.
Okay. So we have bad debts, and let's just say the range is 0.2% of annual sales. That's sort of a ballpark benchmark kind of a thing for U.S.-based companies. Anyway, they tend to be in that range, 0.25%, something like that. Anyway, okay, so we have this benchmark, and then something you mentioned a couple of minutes ago was management overrides, and now we're talking about performance metrics, right? And one of those performance metrics is bad debts. Bad debts is a percent of sales. Well, it occurs to me that some of those bad debts are the result of management overrides of credit decisions. Okay?
Yeah.
So each and every single time in the last 20 years that I was a credit manager on a full-time basis, that I presented bad debts, I presented, at a minimum, two numbers. Bad debts as a percent of sales, and bad debts as a percent of sales that resulted from management overrides of credit decisions. And so, if, by the way, let's say the metric was less than 0.2% of sales. Okay, that's the bad debt target for the company.
Yeah.
All right. So management says, well, bad debts are 0.3% of sales, or bad debts are 0.4% of sales, or 0.6% of sales. And my response is, my bad debts are 0.17%. Total bad debts are 0.6%.
So you kept record on that.
The difference involves management overrides of credit decisions. In one case, I joined a company, and within 2 months, there was an almost $9 million bad debt loss. Okay. So the treasurer of the parent company calls me to San Francisco, fly to San Francisco, come talk to me about this $9 million loss. I said, sure, I'm happy to do that. Flew up to San Francisco, arrived at his office. Did you bring the file? Yep, I brought the file. So you released a $9 million order, and 3 weeks later, the customer filed for bankruptcy protection. Yep. What analysis did you do? Oh, I did an analysis of the risk of doing business on open account with this customer and releasing an additional $9 million.
Yes.
And what was your conclusion? And my response was, my conclusion is that that any decision to release this $9 million relates to a decision of greed versus fear. Either we're so greedy for the $9 million that we override our fear of a $9 million loss. And he said, the treasurer said to me, so what happened? I presented that information to the president of the company that I work for, this subsidiary of this company, and he went, release it. And he said, do you have any of that in writing? And I went, of course. What do you have in writing? I went, all of it, every single word, including greed versus fear. And I'd been with the company a couple of months at that point in time. I had never met the treasurer of the parent company. I assumed I was going to be fired over the $9 million loss. That didn't happen. The president got fired for approving the $9 million.
Lucky you are.
Yeah.
Lucky you are, because
or not. Is it lucky, or is it that we do our jobs and that management overrides are inevitable? And at an absolute minimum, we need to document the
absolutely.
fact. And when it has a negative impact, we need to document that too. How easy would it be just to do bad debts as a percent of sales? Well, that's easy. What were sales? What were bad debts? Boom, done. Is it more complicated and more time consuming to break out management overrides? Yes. Is it worth it? In my opinion, yes. I've had numerous times just that little bit of effort, that little bit of foresight, that little bit of documentation was, in one case, saved my job. In other cases, saved a difficult discussion with the senior executive management of the company about why were bad debt losses 0.6% of sales instead of 0.2% of sales. My answer is 2 words: management overrides. But I know a lot of companies, and I've consulted with people, and I've spoke to friends of mine that don't bother to do that additional work, and that's something I'm that's something I'm energetic about. It's like, why not? Why would you not want to capture that information for your knowledge and for upper management's knowledge?
I think here in credit management, we got a kind of issue, but I got more or less the same experience, actually, because there was a moment in my life where we're supposed to increase a credit line for a customer in Nigeria from 3 million to 10 million. And I had a very good boss. She was at that moment of time, she was a company controller, corporate controller. She came to me and said, can you please tell me what is the risk? I simply said, taking into account the stage of this, and this is quite a comprehensive deal because this manufacturing, quite complicated project, but I supposed to say something very direct and clear. I simply said, assuming Nigeria country risk, assuming the stage of this company and assuming the financial stance of this company, I can tell you this $10 million should be treated as money we're supposed to lose every single moment of time from the date we increase credit line.
Mhm.
Then you take it, and then this is management decision. But what we say, this is the risk exposure. And here, since we already talked, I believe we got a kind of issue in credit management, which looks like when we come to non-specialists and to other stakeholders with default probability
Mhm.
is meaningless to them.
Mhm.
I had a very nice example because you told in the beginning that you were reporting to sales manager to sales director. I had well, once in my life, once in my corporate career, I had a luxury because I was able to say I got two bosses.
Mhm.
I've treated sales director as my boss,
Mhm.
and I was reporting to CFO.
Mhm.
But I used to say that credit manager has two bosses and supposed to make both of them happy at the same time.
Right.
So I had very good relations. So I mean, to give you an example, sales director was calling me each time he was taking the smallest decision, concerning receivables. He
Mhm.
was calling me and said, let's discuss. I was always happy to come. We had perfect cooperation.
Mhm.
One of the best, I had in my life with the sales. And once in the very beginning of that cooperation, we were sitting three, my boss, CFO, him, and
Mhm.
myself, and said, "Can we give this customer credit?" I said, "No." Why? Because they got 10% default probability.
Mhm.
What sales director told me, I'm still use it as example, said 90% probability that customer will pay is enough to me. So this is not an argument.
Yeah.
You need to find something else.
Yep.
So I believe to me, because this is my question to you.
Yep.
I see you already got something to say.
Yep.
This language of probability.
Yep.
When we put $1,000,000 and 5% probability, it's just like we are we are measuring pears by apples,
Mhm.
something like that. What's your opinion about that? So when we say about credit risk, how can we measure it?
Sure. So great story. My similar story was I was interfacing with let's call it the sales manager, the director of sales, or whatever it's called, the top guy.
Yeah.
And we had one of those discussions, and we were having this discussion. I said, yeah, that's a very high risk of default or bankruptcy. And bad debts, as well as serious payment delinquencies, are very high for this account. And so I'm going to decline to double their credit limit or whatever the request was. And he said, go ahead and do it on my authority. And I said, you have no authority. And he said, I'm a vice president of this company. I said, right, yes, you are. You have no authority to override credit decisions. Well, why not? Because you have no bad debt reserve. What do you mean? There is a bad debt reserve, and it is not sufficient to take these types of risks. Could we cover this one if we took no more risks for the rest of the year? Sure. Our bad debt reserve, as we were just talking about 10 minutes ago, is 0.2% of sales. That means we have to be correct and able to collect 99.8% of all shipments, all money that is owed to us by customers. If using your 10% probability, there's a 10% probability of default. Yes, I understand that. My bad debt reserve is 0.2%, not 10%, and that's for the whole year, for the whole company, for every customer that we sell to. Now, that comes back to, if you get authority, or you get sufficient authority from someone else to direct me to do that, and that other person has sufficient authority to tell me this is a management override, go ahead and release the order, I will. But it's important, and by the way, it's very simple. I don't need their thumbprint. I don't need blood. All I need to do to validate and confirm that this was instructions given by management, and I've done it so many times it comes trippingly off the tongue.
Yeah.
So what I would say, is, dear manager, dear boss, as you instructed, I've released the order for $9 million for Kenco. If there's any problem collecting or any other issues with that $9 million, I'll be certain to keep you informed. I'm done.
Absolutely.
I don't need a confirming email. I don't need a signature. I don't need blood. I don't need a thumbprint. I don't need anything else other than, as you instructed, I've done this thing. And I think people get caught up in, well, how would I document that? My response is, a 16-word email comes right to mind. Make it as simple as possible. Don't feel like you're pushing your boss into a corner. But if something comes back, you pull out that email and go, there it is. I sent it to you. And it was a follow-up to a discussion where you told me to do that.
Absolutely. I mean, I got a very nice story about crying credit analysts. I mean, credit analysts, the job of them, I mean, there is a principal difference between the job of the credit analyst and credit manager and business manager at all. I mean, credit analyst calculates what are the odds in the casino of reds and blacks.
Right.
Yeah, so everything is calculated, and the manager who makes a bet. The thing is, obviously, we can use our judgment as a credit manager, but we're supposed to step out of credit analyst role. But you're absolutely right. From certain extent, this is supposed to be management decision, and our job is to provide management with true and clear view of risks of receivables portfolio. And thank you very much for reminding today that bad debts provision, because thanks to IFRS 9, there is already a possibility to do that and to reflect it in the bad debts provision. So we reserve our profit. And so I found actually, just to share with you and with everybody, I found quite useful a methodology where we calculate customer credit worthiness not as a probability, but as an amount of money which we can safely trust to a counterpart. It could be zero, it could be something, but in that case, we simply compare credit worthiness with a credit we grant to a customer, and we clearly see risk as a difference. So difference as a risk.
Yep.
And in that case, what I found quite beautiful and a bit surprising to people, that in that situation, the risk, like probability of default or something, becomes really measured in money. So when let's say the credit worthiness of a customer is 100,000 and we grant $10 million credit, we clearly understand that we're supposed to put $9.9 million under risk. And what is our profit? What benefits we got against that?
Right.
So our management become clearly informed about what they do, what decisions they take, because too many decisions, one of the funniest measurements of credit risk I've heard in my life, I've seen it, because I've seen it with my own eyes. I believe you've seen that, I mentioned that on social media a couple of times. In quite big multinational company, request for credit was included the sentence, contained the sentence, there is no credit risk because customer has paid their last 2 invoices on time. Don't laugh too loudly, but I've read that with my own eyes. It's not like I created that.
Yep.
I mean, that's impossible. And we discussed what are the tangible measurements. We understand that this is supposed to be, that the goals we achieve supposed to be clearly defined, and they're supposed to be numeric. One last thing I wanted to ask you about is that there is a general habit to compare bad debts with sales. My view on that is a bit drastic, because if I look at this number with the eyes of shareholder,
Mhm.
of business owner,
Mhm.
and when I see that somebody compares bad debts with the sales turnover,
Mhm.
my question would be drastic. I would say, why don't you compare this number with the distance from the Earth to the Moon or to the Sun?
Yeah.
Because you take the biggest financial number and compare it with the bad debt. Because if I am a business owner or CEO responsible for
Mhm.
the whole result of a business,
Mhm.
and if I have a stake in this company, I suppose to see how this bad debt corresponds to the net profit distributable to me. Yeah, because to me, bad debts means money I didn't receive because somebody's decision.
Sure.
Yeah, the
So,
floor is yours.
so a number of comments, and I've been taking careful notes as I tend to do.
I see you taking notes, which I appreciate.
So, let me make a couple of axiomatic statements, and then I'll talk to something that you were just addressing. So,
Mhm.
I think it's important, and this is stepping back about 5 minutes. It's important for everyone on the call to remember that not every good business decision is a good credit decision. And if you just remember those 10 words, not every good business decision is a good credit decision, it explains what management is permitted to do, in fact, instructed to do, required to do, make good
Sure.
business decisions. Okay. Um, there was another comment about they've paid the last 2 invoices on time. And that's another one of those statements that I just rattle off every time somebody says something uniquely stupid like that. What I will say is past performance is not a perfect predictor of future performance. If all we had to do was look at the past, we'd all go to Las Vegas and win the bank because we'd play roulette and figure out that black came up last time and we'd bet on it again. Past performance is not a perfect predictor of future performance. One of the things I think is interesting about the last comment you made, and it related to the relationship, if you will, between bad debts and profitability. And so it's almost a rhetorical question for the attendees. I think you and I would have an opinion immediately about it. But the question becomes, and it's often overlooked by credit pros, is does profitability or should profitability have an impact on credit decision making? My answer is yes. And that's a little bit controversial. But for anybody who thinks it's controversial, let me give you an example. Would you take more risk if a customer had the profit on sales to a customer was 1% or 10%? I think every single person would say, well, it would make more sense to take more risk if the customer was generating 10% after tax
Mhm.
profit instead of 1%. Okay, well, that kind of proves the point then that bad debts and profitability certainly has to be part of the assessment, part of the equation, part of the evaluation that goes into how much risk is acceptable, how much bad debts are acceptable to the organization, because every company's tolerance for risk is different, just like every company's after-tax profit margin is different. So there's no one right answer. There's no single thing where we say that's the magic number and that's what we need to strive for.
Absolutely.
Yeah. Yeah.
I mean, here I completely agree with you. And I suppose to say that the set of performance measurements, I specifically use plural because before we go to our last today's question, prescribed question about the performance measurements, I will show just one picture. Uh, it's supposed to be unique and the goals to be clearly defined, and goals in terms of specific number to be achieved by a credit department, or let's say this combination of KPIs, if we can
Mm-hmm.
do it like this, supposed to be really company, market, and specific stage,
Mm-hmm.
and stage or development stage or current situation specific.
Mm-hmm. I agree.
So this really a creative job for the management and for credit pros as well.
Mhm.
So how are we supposed to correspond? What is achievable? What is not achievable? What is our best? And so this is completely individual. And honestly speaking, I've seen many examples of, you know, of DSO benchmarking.
Mhm.
That we cannot compare DSO of even two companies on the same market because
Mhm.
they got different market position, they got different stage. For one company, cash is important. For another one,
Mhm.
this will be a market share, so they will be more aggressive with the longer credit terms. So if we compare them to, if we try to fit to fit our achievements to the to the DSO of another company, this I think we just do really a bad job for ourselves and for the company. Like, I mean, there are many examples of that. I won't go that far about it. And the last thing for today, we know that one. I promised to show a picture. Preparing to today's discussion, I started a poll on LinkedIn
Mhm.
because it was quite simple. I just wanted to know how many people do believe that the DSO is enough to measure performance of credit department. I see Ludo is here. They, together with Joseph Buzutil, they wrote an article on about the DSO, and it was to me that was before that I had doubts that DSO is enough, but so many people measure credit management with DSO, especially outside of profession. So their article, gentlemen, Ludo, thank you very much for that. That article was, just like enforcing my doubts about the DSO as the unique measure for credit management. I wrote my own article, and since then, I actually decided to start that poll and see how many people still believe in DSO. And I believe you see it.
Mhm.
To my rejoice, only 9% out of 90 people believe that DSO is enough. So I believe in terms of credit management and credit management understanding, we really growing as a profession. And what are my question to you and my question to us both.
Mhm.
What are, based on your experience, what are the measures could be found useful to measure a credit function and make sure we objectively do a good job for the company?
So it's really interesting. You can always tell when I'm excited by a question because I start leaning forward. So this is
I see.
this is one of those great questions. So first of all, I completely agree. We can't limit ourselves to one or two or three measurements. But all companies are going to expect and see and calculate the ones that we all know about, things like DSO, DDSO, BVDSO, CEI, the collection effectiveness index. They're going to look at percent 30, 60, 90 past it. Those are just like everybody does that, and we should expect to see that. More importantly, as I mentioned, we should be reporting that on a monthly basis. And maybe we do a presentation quarterly, but at the end of every month. And by the way, it gets much easier. It gets so easy to do. If you have, let's just say you only have 10 things you're going to report on the status of each and every month. Once you've sort of overcome any sort of delays or reluctance or reticence or uncomfortable, it becomes very easy to generate that information, and you start seeing very interesting trend lines that are interesting to you in the senior management. But there are what I refer to, and we talked about it in the pre-show. We were talking about non-traditional measurements of credit department performance, and they're more like KPIs. They're more like things that maybe you don't report to management, but nevertheless, you as the manager are very interested in. If I could, I'd like to give, I don't know, a handful of examples, just literally off the top of my head. So we're processing credit applications. This is example number one. On average, ask yourself this question. Do you know on average how long it takes your department to process a credit application?
Mhm.
And let's just say you don't know the number. Well, my response would be, well, you should. Because if it's 10 days, that may be okay. And if it's 20, that may not meet customers or sales expectations. And if it's an average of 30 days, it's not going to meet anybody's. Management's not going to be happy. Customers not going to be happy. Sales is not going to be happy. But that's a non-traditional KPI or measurement that we ought to do. It may not be on that senior management report, but we ought to know how long it takes. What's another example? Okay, how long on average does it take to process a credit memo? Now, your department doesn't actually process credit memos to offset deductions that customers have taken.
It's
But
not
how
that much allowed due to segregation of duty.
Sure, right. Absolutely.
Mhm.
But how long does it take? Once we've identified that that pricing deduction the customer took was in fact correct, how long does it take? Does it, again, is it 5 days? Maybe that's fine. Maybe 15 days is fine. But maybe 115 days is terrible. Well, step one is you got to measure it. And then you've got to decide whether or not that's acceptable. Maybe 15 days for
Sure.
processing your credit application is perfect. Another thing you could measure is how long on average does it take after the account becomes past due before the first phone call takes place? On average, not every single customer, but on average. Is it a day? Do you have a policy on that, by the way? If you don't have a policy, you probably should. Because if you don't have a policy that says within X days, customers are going to be contacted about the status of their past due account, then every single one of your collectors gets to decide how many days they should wait. Is it 5 days? Is it 15 days? This actually happened, and you'll appreciate this because I'm sure you've had weird consulting assignments. And I tell this story because it's expressive of this frustration I have with sort of everybody gets to decide for themselves what KPIs ought to be or what the rules are. So I went and did this consulting assignment because the company was having cash flow problems. For convenience, their terms were 45 days and they were being paid in an average of, we'll call it 75 days. So they're being paid 30 days late on 45-day terms. Everybody's got that.
Mhm.
I went out there and I sat down. I had 5-day assignment to figure this out. So I sat down with the accounts receivable team, the collectors, if you will, and I said, okay, well, in what order do you call customers? Well, I started A and I ended Z. And I went, well, that's a disaster because that's not prioritizing calls. Okay, but okay. So when do you call them? What's the policy? What's the strategy? What's the KPI about how soon after the account becomes past due? I was speaking with the accounts receivable supervisor, and she says, we give everybody a 30-day grace period. We don't call until the account's 30 days past due. And I went, okay. So I went back to management and went, well, you can pay me for the rest of the day, but my job is effectively done. And you don't have to pay me for the week. I'm just going to jump on a plane because you haven't measured that particular KPI, that particular, I'll call it a turnaround time KPI. And because you don't measure it, you have no idea what it is, and your collectors have no idea what the expectation is. And as a consequence, if you think about all of the functions that you do in credit and collections, all the back office stuff, all of the things that you could measure, my suggestion as it relates to non-traditional measurements, the things that we haven't talked about except for those 3 examples I gave, please consider measuring and creating metrics for and expectations about turnaround. How long should it take on average? Just like you would have, I think, hopefully, expectations about, so the customer says they were to get a 10% discount, and I asked the salesperson whether or not they were correct. How long should it take for the salesperson to respond to that question? You have to have some expectation. If it's 5 days, fantastic, but I doubt it's 55 days. But just like you put expectations on other your coworkers in other departments, I think we as credit pros, as managers, if you will, or supervisors or leads or whatever we are, have to start measuring to some level of detail about these turnarounds. And I can think of another dozen, and I'm sure I've written about them on my website. But yeah, again, turnaround is important, and it is non-traditional, and it will, does it assist in those macro goals like limiting bad debt losses and payment delinquencies? Of course it does. But you don't get to limit bad debt losses by simply creating a metric that says we're going to measure bad debt losses. There has to be some subsets to that of the things that we do to ensure that we achieve the target. And simply saying we have a target does not in any way provide the level of guidance that the rank and file, that the guys that are doing the work on a day-to-day basis need in order to take the right steps in the right order to result in that, the ultimate goal of, we're going to limit bad debts or we're going to limit delinquencies.
We cannot simply say, I mean, what you just said created another 1,000 questions in my head. I mean, that's why I enjoy our discussion, but I will share a couple of things, and then I will ask you a question.
Sure.
Obviously, we need to create, and I do believe there is no one size fitting everybody. But from my side, I always, and when we set a goal, obviously there should be a robust process to that.
Mm-hmm.
We cannot simply say, because, I mean, taking your last sentence, we cannot simply set a goal of 0 bad debts.
Right.
Without process, without understanding what we will, without strategy, what will we do? That's, I give you an example. In Russian-speaking business environment, there is a quite common stereotype that if you give bonus to salespeople,
mm-hmm.
and put collection responsibility of them, you will have 0 overdue. I said, if you give me $1 million and ask to play a violin, I won't become Paganini. If you pay me $10 million, I won't become Paganini neither.
Mm-hmm.
Just because I'm supposed to know how to collect cash. I'm supposed to be trained how to collect cash. I'm supposed to understand the situation. I'm supposed to define what to do. And then coming back to, and then this million or whatever money or bonus will make me doing my best, knowing what is needed to be done. And but when we come back to the specific measurements,
mm-hmm.
I still believe that we could make it. We could make it. Let's say let's use an example of bad debts and use an example of bad debts and overdue.
Mm-hmm.
I don't believe in percent, because percent is very easy to manipulate. We got the same overdue, receivables grew, and we got very good result doing nothing.
Mm-hmm. Mm-hmm.
So my understanding is that in very general term, we're supposed to work with absolute number. Let's use overdue as example.
Mm-hmm.
In very general term, job of us, of credit pros and collectors and everything is not about collecting cash. It's about how many customers we make paying on time.
Mm-hmm.
Because customers are supposed to pay on time. It raises a very big concern, like how we manage credit, how we establish the credit terms, whether or not they are appropriate or not, and so on and so on and so on. But real job is that when we look at overdue, it's supposed to go down.
Mm-hmm.
And if it goes down, they might be doing right job. If it is growing, there is a big question to us. When we take bad debts, I don't believe this is full responsibility of management, taking into account that not all credit management people do have underwriting authority.
Mm-hmm.
But if we see bad debts growing, there is a big question to a company how credit decisions are taken within this company.
Mm-hmm.
What is the way, whether or not people who take decision got full information about what they decide about, whether or not there is no conflict of interest, and so on and so forth. And the thing I want, so I prefer to work with absolute number. And coming back to universalization of that, my preference is that the company is supposed to somehow calculate the comprehensive cost of servicing receivables.
Mm-hmm. Mm-hmm.
Because we know, we already mentioned that bad debts could be avoided, but the cost of their avoidance could be much more high, either by using too high cost of security or a very high cost of sales reduction. So this comprehensive cost is supposed to include losses of customers or cost of attracting the new customer instead of the one who left.
Mm-hmm.
And if we combine this everything together, this would be a number we could work with and optimize. Obviously, we're supposed to look at the salaries we pay to credit management. So using the eyes of a business owner, if I put 5 people in credit department, I expect better receivables.
Mm-hmm.
Otherwise, it is not completely clear what these guys are paid for.
Right.
So the cost could be a good answer to everything, since this is money and we're talking about credit management, again, money, and business is about money. One question I wanted to ask you, because I found your approach very interesting. If we believe that receivables exist to support business growth,
mm-hmm.
or support sales,
and
how can we measure this support? What would be your suggestion?
Measure credit. Okay.
How can we measure a business support by? It's not like this is the subject, because sitting in my mind for quite a long time, that sales director I already mentioned today, once told me we should not have reasons due to which we undersell. So we had very very frank, very direct discussion. Said, how can we make sure that our credit facility is adequate to our business? So what is your suggestion? What are your ideas about how can we measure business support provided by credit?
So another way of asking this question is, how can we increase sales?
Yeah.
It's tangential. It's not quite the question you asked, but it's a question that I can answer, which is,
if you simplify, the more drastic, the more brutal we treat ourselves, the more brutal way we take to challenge ourselves, the better job we as credit pros do.
So here's, and I can think of 20, but here's a handful of ways that we can increase sales right now. Basically, almost no cost, very limited cost. You can identify customers that qualify for a higher credit limit.
Yeah.
The credit limit is 10, they qualify for 20. It helps. It's not a game changer, but it's okay. You, on a quarterly basis, you can ask your salespeople to tell you which of their customers need a higher credit limit, and then you can go try and approve that higher credit limit. You can be more creative in the kinds of additional assurances of payment you're willing to accept. You may accept intercorporate guarantees, but you've never accepted a personal guarantee. Well, maybe you could increase your credit limit by accepting personal guarantees. I'm suggesting that is an example, not the only example of ways that you could increase creditworthiness through non-traditional measures such as increasing guarantees. You could create a mechanism, a very simple mechanism, where sales can appeal negative credit decisions made by you, the top person in the credit department. It could be as simple as they go to their boss, you go to your boss, and the sales manager talks to the controller or the CFO, and whatever they decide wins. But that's a way to increase sales. And you can use the resources that you have, all the access to all of the credit reports that you have, to identify potential customers or potential increases in credit limits for existing customers or potential new opportunities that they'd never thought of involving existing or potentially new customers, because you have access to certain reporting from third-party service providers that they don't. So there's 5 ways that you could do this tomorrow. But you asked, how can we measure it? Well, one of the ways in my last job as a credit pro, I sent out, I forget what they call them, Zoom monkeys or monkey survey. Had monkey in the name. It was a survey that I used to send out to SurveyMonkey. That's what I knew I'd get it eventually.
That is a SurveyMonkey, yes.
Yeah, SurveyMonkey. And I go, how are we doing? And I don't mean how are we doing. I'd ask 10 questions about, responsiveness, timeliness, accuracy of decisions, those kinds of things, and 7 or 8 more. And ultimately, of course, it would be on a scale of 1 to 10. How are we doing? And of course, I was most interested in the last number, but I certainly paid attention to all of the responses. And yeah, you don't get 100% response. You only, as a large measure, you get people who are complaining about something that will respond to these surveys, which is just fine. It's just fine that what we're getting are complaints and concerns, because that's how we grow and improve. If everybody pats us on the back and tells us what a great job we're doing, that doesn't improve our performance. But when somebody says you're too slow and you're too conservative and you're too risk averse and you're not responding in a timely manner, I'm all over that, because that's the kind of feedback I need as a department head to tell me where I need to focus more attention or more resources. Because it's not always just this person needs to be talked to. Sometimes this person is overworked and needs more help.
Yeah, I see. So in the end of the day, even customer service, because we're supposed to provide customer service, good customer service means more sales.
Mm-hmm.
There are lots of things to measure, and I like, because I didn't treat it and never thought this could be a KPI, but I said in my last corporate department, I simply set a rule that every blocked sales order is to be treated within 30 minutes.
Yes. Yeah.
I mean, it might be positive answer, negative answer, but provided that negative answer is not simply no.
Yes.
Because negative answer is supposed to be, we cannot do that due to ABC reasons.
Right.
Here are there are XYZ ways to improve the situation. If there is something else, please tell us. This is the template.
Yes.
Created by my team. But the thing is, just by email received 1431 means that 1501, there should be a reply from a credit guy with all of that, or a telephone call that you need more time, this is a difficult situation, but within 30 minutes, a customer service person who is eye to eye with the customer supposed to receive an answer, which means customer service.
Right. Yep.
So this is it. Again, about the sales support, the measurement I proposed is it is deriving from the methodology we mentioned today. We take sales focused, we take our either weighted average payment term, or we take our standard payment term. We calculate receivables. So how much receivables we need in order to achieve these sales with this credit term, provided all customers pay on time. And then we compare that with the credit limits, with the total of credit limits. So if we have credit limits too much higher, that's an interesting question, why we got these limits. But if limits just represent 50% of needed receivables, then this question to us whether or not we are really assess our future adequately. And what we could expect if we got if we've got what we called credit demand of $20 million,
Mm.
And we got credit limits only for 10. So we expect customers pay in advance. If this is strategy, it is accepted. But if it doesn't work, then well,
Right.
what?
Yeah.
How is it supposed to work? Okay, well, I believe we've covered our program. I'm not very good at moderation of discussions, but just because I call as a cost speaker so intelligent people like Michael today. But we got questions, ladies and gentlemen. We got a very interesting question from our colleague at Credit Pro.
Okay.
I can even provide you with the name. This is Declan Flute.
Okay.
And please type your questions in chat, and we do our best to answer them. So we got challenging question. It sounds like, how should we measure the impact of lockdown on a business? Some businesses will survive, some won't. How can we know the difference in advance? Whether or not, Mr. Dennis, you would like to be first.
So, no, I wouldn't, and I'll take it anyway since you offered. So
Now, I can start myself.
So sadly, I had it here just a moment ago, my crystal ball, and I dropped it. It broke.
Ah, so it is broken now.
Yes, it's broken now. That, it's analogous, I think, to asking a new restaurant open up down the street, and at least in the U.S. and in North America, restaurants open and close like this.
Yeah.
Is this the restaurant that's going to survive, or is this the restaurant that's going to die? The answer is, I don't know. Only time will tell. Which of your customers are going to survive the lockdown? The answer is, I don't know, for a variety of reasons. I don't know what their financial condition is, their financial health is. I don't know how significant the impact is of the lockdown on their business. And I don't know what government intervention will be and how significant it will be, and whether or not they will qualify for that government support. And as a consequence, I can't answer the question about which of our customers will survive, because it doesn't work that way. There's no metric that I can point to and say, well, if they have this much in the bank, or if their business is only dropped by 20%, or if their bad debts have been limited to $1 million, then they're going to survive. My answer is, every single one of those is going to be different, but it's analogous to, is that restaurant that just opened at the corner of the street, are they going to be in business in a year? And the answer is, I don't know, only time will tell.
Well, since we got time, we got no other questions, I will start from very far. Quite recently, a Swiss Association of Credit Management did a research. What they found, that about 40% of Swiss companies don't know financial stance of their customers. For them, there is no way to predict. Mm-hmm. And I mean, if you don't, if you don't wash your hands before taking a meal, what is the probability of having dysentery or whatever it is, or of having diarrhea? Yeah? I mean, maybe there are lots of things to be done in advance. And another thing, I don't know if we got a black swan with the lockdown or not, but as soon as we understood that there is a lockdown, we can assess what's supposed to go. And if we got financials of our customer, mm-hmm. we can at least try to assess what it is. This assessment is not really a guarantee, or just is not a crystal ball, but at least something better, which which makes us different from being blinded.
Mm-hmm.
Although we are in a heavy fog, it is much more better than being completely blinded, like this, or like just covered eyes or having no eyes at all.
Mm-hmm.
Yeah, in a fog we can see a little bit. But what I was saying in the beginning of the lockdown, we were having a webinar. I said, ladies and gentlemen, if you didn't do your credit assessment before lockdown,
Mm-hmm.
don't start it now.
Mm-hmm.
Because classical risk assessment, knowing there is a lockdown, will never work.
Mm-hmm.
During the time of lockdown, you're supposed to be able to do a risk assessment plus stress test and see what level of impact every of your customer is able to afford.
Mm-hmm.
If your customer is able to got cash for 3 months,
Mm-hmm.
that's one story. Another of your customers has cash only for 1 week. The same story if the sales of your customer will drop by 30%, what will be an impact on their business? Again, this is not a crystal ball, but this way you at least able to see the higher or lower probability of this or that customer to survive. Because in this crisis time, there would be, as the client clearly said, there would be customers who will die. There will be customers who survive. If we come back to United States, and I'll always recall Professor Altman, who says that majority of bad debts do not happen at the time of crisis. They happen two years later.
Mm-hmm.
They happen in 2 years. So we didn't see the real picture yet, because very often companies got their excessive cash, or they're changing their way of consumption, and so on and so on. So it is coming, but this is our window of opportunities to calculate and see who gonna survive, who will survive with the limited support provided from our side, so we maintain supply chain,
mm-hmm.
and who will die with every support, every possible support which could be provided. So this is our job as credit pros.
Mm-hmm.
The question to ask, whether or not we used to analyze customers and got right in hand credit analysis, whether or not we model the model, we make a model of, we understand our customers' business model.
Mm-hmm.
We see how does it work. Whether or not we're able to do a stress test, even basic one. And then we're supposed to come to an answer. Yes, but since we are measuring performance for situations like lockdown, this is complete disaster. There is no measurement for the disaster.
Mm-hmm.
Another question for us, since we already have an experience, I believe every credit department is supposed to have that credit disaster recovery plan.
Mm-hmm.
For the situations like this, just on a piece of paper, whether or not we've been modeling that situation in our portfolio, so we at least got an idea what to do in such a situation, or we will simply, raise our hands up and say, okay, will happen what it happened. Like, what is, final joke for today, I try not to say them. What is your strategy? We run as a deer in a firing wood. Destiny leads us. So that's only our choice. I prefer to base a strategy on data. You had to say something.
So there's two comments. We both started that discussion by talking about financial statement analysis, customer financial statement.
Yeah.
You mentioned 40% in Switzerland. My guess in the U.S. is it's 10% of creditors have I'm sorry, creditors have financial statements on 10% of their customers, maybe 5. It's
you got different legislation.
Yeah, it is astonishingly low. Basically, you get them from public companies and no one else.
Yes.
So trying to model without financial statements to model against is well, fruitless. How do you model without the numbers to model? So that is a limitation, unfortunately, that we have in the US. If you are in a different place or you have ready access to customer financial statements, fantastic, because then more things are possible. I also read Svetlana's question, how often should we update customer financials?
Let's start from this.
I would love to do that one if I could. So here's my answer, Svetlana. There is no magic answer. The answer is dependent in a very real sense on your company's expectations and the assets, the resources that you have to do updates. It's also impacted by management's expectations, because one of the things they expect us to do is manage risk. And in order to manage risk, we have to update customer credit files, including financial statements, periodically. Now the question becomes, how often is often? How fast is fast? And the answer is, once again, that it depends, because it's resource dependent and there are resource constraints on all of us. Not even if we could get access to this information, there's still a resource that's required to do the analysis. What I would say is, to the extent that management has this expectation and you have guidance that you need to manage risk, that those are two factors you need to take into consideration. And then if there's a limitation on how much you can do versus the total demand, the total possible workload that you could conceivably do, then you have to strategize and prioritize. Then you have to, something we talked about earlier, you have to look at the risk of doing business. You have to figure out, as an example, I'm only going to do financial statement analysis on customers that I identify immediately as being high risk or have credit limits in excess of $1 million or €1 million. You could do it that way. Or you could risk classify every single one of your customers and create different update calendars based on the degree of risk that you perceive. All customers risk rated 10 get reviewed once every 10 months. Ones that are rated number 1 get reviewed once every 2 years. And there's a division in between the ones that are rated 1 and the ones that are rated 10. But the answer is, if you don't have the resources necessary to do the analysis, you've got to prioritize it in some way. And the way that makes the most sense, to me at least, is based on the perceived risk of doing business with that customer, whether it's an objective risk based on financial statements that you've already done, or subjective risk based on their slow payment to you or others, or it's based on something objective like the credit limit, the large credit limit that's been assigned. Those are all viable ways that you can identify the priority with which I at least would address that particular issue of how fast is fast enough, how often is good enough. Back to you.
Thank you. Svetlana, since Mike already started to answer your question, I will add, by practice, I used to set to set a simple rule, although there is no common rule for everyone. Availability of data could be an issue, but there are ways to avoid it. I had an experience where I was coming to a customer, having their financial statements without being allowed to copy them, just to make my to calculate my ratios, shake hands and leave. But that was already our appreciation, so they shared. No. I mean, be the gentleman. No, I was just calculating with the calculator everything and see the financial statement. But again, this is exceptional question. If assuming that you got financial statements of every customer at least once a year, you're supposed to do that, and supposed to do also your portfolio analysis and see how it is changing. Then we may go too much in details. How to do that? Give me a call offline, and because to discuss specific situation, but at least once a year. And also here, I suppose I would like to mention one thing. you don't need to you don't need to fight for the speed of credit analysis. Credit analysis is supposed not to be done fast, it's supposed to be done on time. So each time you take a decision on your customer, your management's supposed to take a decision on your customer, you got that analysis in hand, or you're able to say at least something about their credit worthiness just based on what. Therefore, that's why, by the way, we do credit analysis not only on fresh financial statements.
Mm-hmm.
We make credit analysis on 3 years or best or better 5 years financial statements, so we can see trend. If there is nothing to say at all, there is no fresh data, we can extend trend and at least predict something.
Mm-hmm.
That's couple of suggestions to say. And then there is a question from Louis. I just said, in your opinion, what is the best organization for credit and collections team? Credit activities for one team and collection for another, or combination of functions for every clerk? Well, it's a good question. Thank you very much, Louis, for that. Michael, what would you say?
Well,
I can start myself.
No. I'll simply make one comment. In the U.S., we have these trade industry credit groups, and so it's a very
sorry. Before you start, we just let's make it quite general.
Okay.
So whether or not there is credit and collection,
mm-hmm.
as it's very often named in the United States,
mm-hmm.
or whether credit and collection are two separated functions.
Mm-hmm.
Because I believe that's what Louis is asking for. Louis, yeah. While we will be answering, please type something so if we're completely incorrect in our understanding, please type something so we can provide a deeper answer.
Yeah. So in the U.S., they are never segregated. All of the groups that I belong to, all the groups I'm aware of, both provide information about the risk, which we'll call credit, and the collectability, which we'll call collections. So all of them do. My answer typically is find the one that has the best fit in terms of the common customers that are going to be evaluated and discussed, and join that one. There are entities that specialize more in doing credit education, and they even those focus on credit as well as on collection. You know, the difference between the CPC and the CCP certification are clearly aimed in two different pathways. CPC, of course, the Certified Professional Collector, focuses on them, and the Certified Credit Professional focuses on the risk mitigation aspect of assessment and evaluation of the portfolio risk and the individual customers that make up that portfolio risk.
Well, I will simply I will simply add to that a couple of things. Imagine you've got only one credit controller within the company. There is no segregation. This guy or lady is supposed to do all the credit job and supposed to deliver result. And what is interesting is that when all this job done holistically by one person who understands customer financial statements, current situation with shipments, payments, and everything, and then the one who has an experience with collection, when this everything one person, the results normally better.
Mm-hmm.
However, I have to admit that in some specific situations where there is a heavy load of collection job, like in telecom, like in utilities, you would never use a strategist who understands all the things like like consumers' disposable income and so on and so forth, which are really necessary to do that credit job. But this person won't be doing collection job just because it won't be effective enough.
Mm-hmm.
But what is important here is cooperation between the two, because the fragmentation of credit function, that's why I mentioned credit and collection, Michael, because once I read an article, I think on the same CCR, which was stating like, collection is not a part of credit management. That was an article written by a quite high caliber credit director.
Mm-hmm.
So, well, I've read that article, I took into account, but I'm not sure that's really an approach. Again, there might be specific use. I'm not challenging. To my understanding, there might be specific situation where we can distribute. But if we say, let's narrow my answer to big B2B customers, the person who understands customers' financial situation, understands customers' business model, knows current situation with the shipment, payments, blocks on hold, knows history, needs only one telephone call to a specific person to solve the issue of collection. Whereas a collector who knows only overdue amount and has contract in hand, supposed to spend hours writing, typing, calling, doing all this investigation in order to collect payment. Steiner, please interrupt. Do you want me to please switch on your phone and say?
Okay, so thank you. Can you hear
Pleasure.
me? Yeah. Hello. So I'm Laurent Steiner. I'm head of credit risk and trade finance for ArcelorMittal Europe. So ArcelorMittal, you probably heard the name. It's a huge company in the steel industry, and I actually had the experience of both organizations in the company until 5 years ago. I think I was head of credit and collection for one of the division of ArcelorMittal Europe, and we have reorganized differently 5 years ago, and clearly separated the two. So credit on one side and collection on the other side. So to answer then, as per my experience with this, both can work, but both needs some really specificities. I fully agree, Andrei, with what you said. That we, of course, obviously depend on the size of the company. But assuming that you are in a company which has a sufficient size and team sizing to divide them efficiently, that can work. And we have actually a collection team which is managing, as Andrei just described, following and clearing and documenting the customer account, chasing the overdues, etc., doing what we call the routing collection. And my team intervene on two aspects. First, to determine the credit limit, to get together whether the internal or external credit coverage necessary, and then take over also for what is, I would say, the hard recovery in case of default. So that can work, but you understand you have two different teams which are owning the same customers. So that demands an absolutely clear, crystal clear definition of the task, a good understanding between the management, and a good documentation of that. And if one of those three aspects is failing, then you will have teams yelling at each other and saying that you are, doing exceeding what you are supposed to be doing, etc. So that can work. That can be efficient. And believe me, at the beginning, I was very concerned about that, because I didn't believe into that. But yeah, that can work. But that needs specificities to be working. Voilà.
Yeah, thank you, Michael. Please.
So Steiner, I agree with you. Clearly, there are scenarios in which you can have a credit manager and a credit group that does the risk mitigation, and there's a collection manager and a team that does the dialing for dollars, as we say in the U.S. And I don't think any of us would disagree with that. I think the challenge, and I'm sure you've experienced it and overcome it in all likelihood, is the concern that basically the problems that are created in the credit decision-making process become the collection teams to resolve. So It's a question of garbage in, garbage out. If we set a $10,000 credit limit or 10,000 euro credit limit for a customer that's creditworthy for zero, then the collectors are going to go insane, working, doubly harder. It's garbage in, garbage out. If we don't make the right decisions initially in the risk mitigation, then our collection team is going to suffer, as are their results, as is the effort they're going to have to put in to do what we expect them to do in terms of turnaround on the receivables. So yes, clearly functionally, there's an easy and simple and obvious segregation between the two organizations. What needs to be in place then is an overarching umbrella that links the two together and says that we're getting feedback one from the other about the potential mistakes, and I'll use that term as a shorthand, the potential that we are taking too much risk on the front end, resulting in significant additional work and potentially payment delays on the back end. So yes, totally agree. And I've worked in organizations where the functions were separated, where the collector didn't do the manager's job and the manager didn't do the collector's job, but they certainly had a tight woven interaction when it came to understanding how much risk was workable for the collection team.
Musali, thank you for participating. Good luck, because I got a message from one of the attendants. As a final word, more or less the same time, I wrote an article about the DSO. I wrote an article about fragmented credit function. So we can have credit collection. We may distribute job between analysts. I will simply echo what Michael just said. We may have credit analysts, we may have collectors, or we may have credit managers doing the whole thing, just specializing on the area. It depends on what resources we have, the current specific situation. What is the real job of a credit manager or head of that department? Is to set the same holistic, integral culture of credit management and extend it even further, not only in credit department, extend it to treasury, extend it to sales, extend it to customer service, to everyone. Because, I mean, I say a joke that good credit manager is master of arrows. Is the one who on that org chart said, draws right arrows and make sure everything works together, because otherwise this will be like like a fish, like a cancer and the bird. Everybody is pulling into different direction, and the thing they try to move will stay on the same place. Ladies and gentlemen, thank you very much for attending. Thank you very much for your kind attention. Thank you very much for your interesting questions. And Michael, thank you very much for two things. First one, for disagreement, which I expected, which I invited you for. And thank you very much for the fun we all had today, thanks to your very nice and positive approach.
Thank you very much for inviting me.
Always a pleasure. I believe this is not the last time.
Perfect.
Have a nice whatever you have now in your territory. Please stay tuned. Credit Chat's supposed to go on. Thank you. Bye-bye.